Hello. Hello and good morning. Hey, Catherine, how are you doing?
I am fabulous TGIF.
Agreed, 100%. Super excited that we are here on this beautiful Friday morning, sharing all about real estate investing and how you can really make the most of your real estate investments. As you can tell, I am in my World Series garb today. So it is game one of the World Series, and I'm going to the game tonight.
Woo
I don't
hoo.
I don't normally record webinars dressed as a baseball player or baseball fan, but today we're going to do that. So,
Okay, what is this necklace that you have on? What is this?
okay, so it's can you see that? It's my giant. I got this chain. Um, hey, these are really popular at the games, super popular. So I'm gonna fit right in. I'm trying to, I guess I'm turning into a super fan.
Nothing wrong with that. Oh, that is so exciting.
Yeah, it's going to be super fun. So, all right. Well, we only have an hour, so we're going to jump in. We're going to make this as kind of a discussion, and Catherine, we'll kind of bounce stuff off each other as we kind of go along. So, I'm going to advance the slides here. So it is time to. We need to start caring about our taxes, especially when it comes to real estate investing. So, Um, one thing I wanted to just kind of talk about is kind of who we are. If I can move things along here. Well, apparently the toilet wants to keep flushing. So a little bit about Unboxed Advisors. So, we're personable accountants, as you can tell. We're approachable. We want to break the mold. We're really providing great service, working proactively, being available. We're really holistic in what it is that we do and how we help people. So we know that we've got to look at the business side of things before we ever get to accounting and taxes. But if we're never asking all the right questions, we're never really able to help grow a business in the right way. We're never able to save taxes that really matter in the long run. And we're never really changing your life for the better if we don't ask like the big questions about what your goals are and where you're going. So we got to make more money. We got to save money by not paying as much tax as we should. And we got to protect money by decreasing risk, and that helps us to go further faster, and that's really really the goal here. So you've met me and Catherine. So my name is Susan Bryant. I'm a CPA and a certified tax planner. And Catherine, why don't you introduce yourself?
So I'm Catherine Meyer, and I am an operational nerd with a history of cultivating winning teams. So I'm here to help you with your operations and apply that strategy that we need to get you to that next level.
Awesome, thank you. I'm so glad you're here. So um as most of you know, we're not we're giving general tax information. So just know that tax can be super complicated, and it needs to be applied specifically to your situation. So just keep in mind that as we kind of move through here, this information is not intended to help you solve your specific tax problem, yet to bring awareness to the typical tax things that you need to know about. So
Mhm.
please make sure that you are working with someone who can help guide you on your specific tax situation. It makes such a big difference. All right. So let's talk a little bit about the stuff that um typically goes wrong first. And that is number one, compliance. So you've got to make sure that you are adhering to all of the state and federal regulations when it comes to reporting. We actually have an issue right now with a client. It's not real estate related, but entity was formed a long time ago, was actually formed as a nonprofit, lost its nonprofit status with the IRS, now trying to do something different. And the client didn't even know that they couldn't convert from nonprofit to a for-profit entity in the state of Texas. So it's
Mm.
almost like you got to start all over. So compliance is absolutely key, specifically when it comes to real estate. You have to understand exactly all the reporting obligations that you have, not only at the entity level, but how are you conforming with the county requirements? I mean, there are, as everyone knows, there's a ton inspections. Are there health and human services? What other specific aspects of compliance do you need to know? Because going wrong in one of those areas can be extremely costly.
And to also add to that, when you're talking about compliance, what is compliant for one business owner, even in the same industry, might not be applicable to you. So it's really important not to try to keep up with the Joneses and to really ask those questions and to work alongside the right advisors to get yourself set up from the beginning correctly. It is like we our client, it's a pain. And it's like paying the dumb tax to have to do it afterwards.
Amen to that. So true. And it's totally avoidable. We just got to work with the right professionals. So, and it's always good to keep coming back and asking the question, like, is there anything I'm missing on
Mhm.
compliance? It's a big piece because as we'll talk later, I mean, new laws come about all the time. So,
Yes.
record keeping is your lifeline. So this is not something that you're just working on at tax time. Keep those accounting records updated. This is this can be a massive, massive problem later down the line. 1, 2, 3 years worth of accounting records that are all wrong. Not to mention, like, you might be overpaying in tax,
Mhm.
or you're not taking advantage of certain opportunities because you just don't have really good records. I mean, it is a constant problem that we see, is that people just aren't keeping good records, or they've got a disorganization. They don't have this standard of making sure that their accounting records are also, getting input on a frequent basis, but they're also not keeping track of, like, I've got all my closing statements, I've got all my org docs, I've got all my banking files. Like, it's all of that other record keeping that matters too. Like, everything's in one place. And there are some really amazing tools available to make that easy, especially for real estate investors. So um,
Mhm.
uh, keep that in mind. Modern tools, let's talk about those modern tools. Hello, automation, right? We got to automate the accounting. There are ways for you to layer tools on top of QuickBooks Online that will enable the accounting to be streamlined. I mean, I joke about this, but like, accountants don't even want to do accounting anymore. But because the technology has made it easy for us to put the bulk of that bookkeeping into the computer to make it do the work. And then we can spend our time reviewing and, of course, working on the stuff that's a lot more interesting. And that is, how do we influence the future in the decisions we're making today? A lot better.
OCR technology is a game changer. Having all of your invoices and bills come in and being able to leverage the technology that the computer will read it and put it into your system for you, that's a labor reducer.
Yeah. And there's even some AP tools that are really fantastic, that when a bill comes in, so let's just say it's like internet service, and you got internet service, maybe you pay for that for all of your rental houses. So all the bills come in, they come in by property, you pay them. There's actually now one specific AP tool that I'm thinking of. It's called Glean.ai. And what they will do is they'll actually compare what you're paying for internet service to what everyone else is paying with that same vendor for internet service, and say, hey, you need to go back and renegotiate. You're paying too much. That's huge. I mean, so the AP tool is not only making your process more streamlined, but it's also giving you information to help you save more money, which I guess leads right into this next thing of, like, financial clarity and making smart decisions. I don't think that there is any, no one will argue with us, that would say, hey, if you have a very clear set of financials, you can make better decisions. I think everybody knows that. I think a
Mhm.
lot of times, business owners, as investors included, they're going based on their gut, like, hey, I think this might be a really good opportunity, but they aren't doing the math to obtain that financial clarity, to reinforce, to affirm the decision making. Maybe they've gotten lucky in making some really good purchases along the way, good decisions. Um, but how much better would it be to have a forecast, a budget, some math done in advance to affirm, like, is this the best decision for me right now and into the future. Tax deductions. This should be pretty basic. However, it's not. So I Catherine and we have this discussion all the time. It's that, you know, you got to make sure that you are keeping your accounting records in such a way that you are going to be able to take the deductions. So you are maintaining your receipts, you're maintaining the documentation, you're actually specifying what the purpose of this amounts are. I'm working right now on a backwork project. And, when you're talking about 2 years worth of accounting records, you can't even remember why you spent the money. And so if we can't substantiate it, we don't have a receipt, we don't have any documentation, we're going to have to just call it a distribution because we cannot take that deduction. And so we're just leaving money on the table left and right. So having that record keeping system is absolutely essential. Otherwise, you just end up paying more tax than you should.
Well,
So
and a lot of business owners that we talk to are like, oh, well, I just take all of my receipts in, and at the end of the year, I true them all up. No big whoopee. Like, this is how I do things. You're exactly right. When you're turning in your tax information in, February and March, now you're looking at things that were 14 months ago, and it is painful. That is painful to go line item by line item. Now, if you can exercise a little bit of your financial muscles and do it every month, that is a 15-minute review, one Saturday a month on your stuff. You're going to know your numbers, know everything about your business. So it's really worth the investment to do that simultaneously for your own peace of mind as well.
absolutely. I just everyone really I mean, we're even getting to the point now, and I've talked a little bit about this, is that there is eventually going to be this push to have accounting information almost in a real-time manner because the tools will become so good that you're almost closing the books every single day because the technology, the automation will allow you to do that. Now you got to configure it, you got to set it up, you got to know how to manage it. And it can be really intimidating to a lot of people, but it helps you to understand what deductions you're going to get and to manage your taxes if you are kind of leveraging all these things together. So really, really the key.
Yep.
The last thing on this slide is just to prepare for the future. Planning, planning, planning is just we have to prepare for what is coming and to align with where we are going, the things we're doing today.
Mm-hmm.
So are we thinking far enough ahead into the future as far as maybe how this property is going to be sold, whether it's going to be refinanced, what's happening in those areas with regards to the significant maybe increase in value, or maybe it's going the other way, intended use of the property, whether we're going to build, whether we're just going to use it as an investment. Like all of those intentions that we have ultimately are dictating an eventual tax consequence. And we need to be talking about it many, many years in advance so that we can be preparing for and creating options for what that might look like. So big stuff there. I'm not sure if it's going to flush again when I hit the button. No. Protecting your assets, man. How many times have we gone over this conversation? Please do not put your business transactions commingling with your personal transactions. It's just a surefire way to expose yourself to unnecessary liability. Still happens all the time. We're still coaching business owners, investors. It seems like it's a very tempting. I think it's very easy for people to just, I don't want to bother with having to set up another credit card or debit card or another bank account. Like I just want everything in one place, but it's just really messy. And like I said, opens up this liability that you just don't want. My recommendation is get that old label maker. right? Remember the one that used to
Mhm.
have like when it would raise, like it would be yellow or red or something. It'd be like on silk.
Yes.
Now I think it's just like white with black print or whatever. But put on the top of your credit card, like business or by property or by entity or whatever it is, whatever your code or your system needs to be. So when you're at that point of making a purchase, you're decisioning right then, like, I'm going to use this card because it's for this entity. Using this card because it's personal. And then that way you don't have to pay someone um, accounting fees to keep track of your personal stuff, which is never going to be a deduction to you.
Okay, so quick question. If I have a bunch of properties, do I need a bunch of different physical cards?
Not necessarily. What you have to have is the right tool in order to manage that. So there's
Okay.
things like Divi, and there's some other tools that allow you to essentially set up a card, sometimes even a virtual card, where you could say, "Hey, anytime a charge gets posted to this credit card, it always gets coded in QuickBooks to this class." So,
Okay.
like those, take for example, like those internet charges we talked about before. So each internet charge would automatically go into QuickBooks, like feed in and sync in by class. So it would always be getting categorized by property. So can
Beautiful.
way streamline those things. And as we all know, most of those charges, the auto pay charges, like you look at somebody's bank statement, like a property manager, or whatever, that's got a ton of charges by property. I mean, the spectrum looks the same across all of that. I mean, it's so hard to know. And unless you were doing a really good job on the bill pay side, you're not seeing that. And a lot of people like to use credit cards because you get the points too. I
Mhm.
mean, so there's a lot of incentives, but you have to make sure that you are thinking like with the end in mind, like what this is going to look like when it hits the accounting records, and sort of back your way into how do I have the right tool set up so I don't have a mess later.
Yes.
So getting those revenues and expenses tracked by property, look at your insurance. This has been a common thing of looking at insurance policies. Like insurance is going up, but in a lot of cases, people aren't looking at what specific coverages they have. So they're either underinsured or the coverage is just incorrect for what it is that the liability or the risk that they're most concerned about. So if you don't have a good agent who's sitting down with you and kind of talking through that with you every year, you need to get one. A lot of times we'll also see people who are using property management companies, but maybe they're missing the opportunity to set up their own property management company. That can be really, making sure that you've got the ROI kind of done on that. And then this new thing, man, we just did a kind of a podcast, if you will, with Brandon Hurwitz from Underwood Perkins to talk about the Corporate Transparency Act. You guys, it's coming January 1st, 2024. You will
And
be,
that video is out on our YouTube channel. So go find us on Unboxed Advisors. You'll be able to watch that entire episode and get all of the scoop.
yeah, and compliance is going to be really important and it keeps changing. So when we recorded that, the law said that you had 30 days after you created a new entity to fill out what's referred to as the beneficial owner information report with FinCEN.
Mhm.
Now they've changed it to 90 days. Like I'm wondering what else is going to be changing
Ooh.
with this law. So you got to stay up to date. So make sure that you are checking in with your accountant and that you have a solid relationship with a business attorney as well. And if you're doing a lot of real estate stuff, certainly a real estate attorney too.
Yes. Okay.
Awesome. Well, cleanliness really is next to godliness. So, um, everyone's sort of noticing our bathroom theme here. So, uh, make sure you're in the right legal entity. Work with a proactive tax advisor. Again, make sure that those insurance policies are getting reviewed and check out your property management agreements. You got to go through all those things on a routine basis. It's probably that legal entity selection process that we find most people are confused about because they don't necessarily know why they were set up as a specific entity. And they certainly do not understand maybe what the state designation means versus the federal designation. And those are two different things. this can often get very confusing, and in the mind of the investor or the business owner, they don't understand the difference or why it matters. So there's a lot of education it needs to go into. And if it's just something you're like, I don't know why I'm an LLC. I don't even know why I'm an S corp. I don't know why I've got this in a partnership. I have no idea what a family limited partnership is. I don't know why. If someone did not explain that to you, then you really need to go back to the drawing board and understand what entity you are in and why, and make sure that you as the owner really get it.
Mhm.
So important. All right. So if you are in real estate, this is probably the area where you get probably the most confused, because it is really confusing. Because there are so many different categories of potential ways that something could be treated from a loss standpoint, especially when it comes to real estate. And let's face it, once you factor in um, interest and expenses, perhaps maintenance and some other things, and the lovely, non-cash depreciation, most times, especially in the beginning years of owning a piece of real estate, there is a loss of some kind. And I have worked with people who are want to be investors in real estate, but they are often discouraged when they find out, oh no, all those losses are just getting suspended. And I put a bunch of money into something and I didn't fully understand the tax consequences. So let's just start by saying, hey, look, if you're investing in real estate and it's being rented, the default is automatically it's a passive activity. It's going to result in passive activity losses. Now, there are a bunch of different categories after that to obtain some type of status that would allow you to take advantage of those losses. So the first of which is if you're a real estate professional. So if you think real estate agent, commercial broker, someone who is investing full time, like that's what they do. They are buying properties, selling properties on some type of routine basis, or investing in them. That is a real estate professional. They are providing personal services and spending at least 750 hours a year doing this. Plus, they've got material participation. So, like, they've got capital that is at risk. Then you potentially could qualify for that real estate professional status, and that does unlock the ability for you to take those losses in and so they are not considered to be suspended passive losses. That can be extremely beneficial. Documentation is the key on this. So really, do you attain that status, and can you maintain it from year to year to continue to receive the benefits of those losses? I mean, nobody wants to lose money, but if you do, you want the ability to deduct it. So you need to make sure that you are being intentional every tax year about how you're spending your time and to maintain that real estate professional status. If you are not a real estate professional, but you are actively working in a rental investment property, then and your income is low, so 100K to 150K is when it gets kind of phased out, that adjusted gross income. Then you do have the ability to take losses up to $25,000. However, you gotta have some skin in the game, so you gotta own 10% or more. You can group rental activities together. That's important to know. And you've got to dot your I's and cross your T's when it comes to understanding what the rules are. So don't forget compliance on this piece. It's frequently overlooked. It's not until you get to the end of the year, and usually people who have significant real estate investments, it's like tax prep time comes along and they're like, wait a minute, I thought all that was going to be helping me, and then they're suddenly really surprised. It's something that you got to be talking about on the front end versus on the back end.
Yeah. Mhm. Yeah. Good stuff.
Yeah. All right, so let's talk about some things that you can be doing And of course, cost segregation studies for commercial properties, it's a no-brainer. You got to do it this year. If it's, 5, 7, 15-year property, potential 80% bonus depreciation, and that's going to decline over the next several years, 20% every year until it goes to zero. If you're not familiar with residential cost segregation studies, that's totally possible too. So it's really affordable and inexpensive and can really make a big difference, especially the higher uh, properties, higher dollar properties that you are investing in. So if you are not familiar with the captive, you should be from a business, uh, like just a business strategy, but there's also tax benefits. So creating a captive is like creating your own private insurance company. So it allows you to privately insure the risks that you have in your business or businesses. So it could be across multiple pieces of real estate. It could be in an operating entity, multiple operating entities. So it allows you to basically take a deduction from your business income, and when you put it into your private insurance company, if it's under the statutory limit, which is roughly a couple $1 million, and it goes into that private insurance company, it's not subject to tax from a revenue standpoint in the private insurance company. So extremely powerful to receive an ordinary deduction out of operating entities and not have to pay tax on the other side. The other thing that I think, especially for real estate investors, that is super cool is that, especially multifamily people, when you have a captive and you require people to have renters insurance, when you have your own captive, you can then turn around and sell insurance too. So that can be extremely powerful, not only on the money saving side, but also on the money making side.
That is a fabulous tool.
Yeah, it can be really powerful. Qualified opportunity zones. A lot of times people will say, "Oh, I don't want to put my money into a, investment that, is with my, financial advisor. I know the QOZ funds that exist out there, but I still feel like it's not right for me." You can create your own qualified opportunity zone. So you can buy real estate in the places where you want to, maybe the places you like to travel. You could start a business in the qualified opportunity zone. And yeah, you got to lock your money up for a 10-year period, but it could be worth it if that's an area where you want to pursue making investments. And it can be an operating business too. So it doesn't have to just be real estate that's sitting in a qualified opportunity zone. It could be, I think even downtown Houston is like a qualified opportunity zone. So you could, start a coffee shop down there and grow it and you make money and you sell it one day, and it is also not subject to capital gains taxation. So can be really awesome. 1031 exchanges. So I don't know a real estate investor who's not familiar with those, but swapping one property for another property and deferring that capital gain. And I was made aware recently by a financial advisor. So, a lot of times, especially now, it's a great time to sell. Maybe not necessarily as easy to find the right bargain in terms of a purchase. So there's actually 1031 funds that exist, similar to the QOZ fund. So it might be a good place to sort of park your money if you don't want to, if you can't identify a property or if you run out of time, because there's a lot of strict timelines on those 1031 exchanges. And then the 179 deduction and the 45L tax credit very much centered around the energy efficiency improvements. So, we're living in times where we're really, there's been a lot of legislation that's encouraged people to try to minimize energy consumption. So the 179D deduction and 45L tax credit, which also require the help of an expert to make sure that you're doing all the calculations right. But if you have made improvements to your buildings in the area of energy efficiency, you should definitely be checking those out. And the 45L tax credit also applies to engineers and architects who are designing energy efficient buildings. So even if you're not the constructing it, that you are on the designing side, you potentially could get a tax credit. And that applies to not only like for-profit businesses, but it also applies to nonprofits like schools, government buildings, churches. So there's a lot of stuff that you should be exploring and knowing there. So, alrighty. Some other things to be thinking about when it comes to sort of looking beyond the real estate itself is that this is kind of a means to an end, right? So what are you doing to think about long-term planning? Are you creating an estate plan? What happens if something happens to you? Are there people in the LLCs that can manage the properties if you are incapacitated in some way? Have you explored family limited partnerships for property that's expected to highly appreciate? And are you perhaps even leveraging your investments in real estate to secure life insurance policies, collateralizing those to, make sure that you're taking care of your family from that standpoint. And then, of course, disability. And then if you don't know that the estate tax exemption is set to change in 2026, it is. So it's going to be cut in half. It's going to go down from 13 million to roughly 6 million. And that, estate taxes are, 40%. If you have significant real estate investments, it's the fair market value of those investments that are considered for estate tax purposes, not the basis, like your cost basis. So that can be a real big surprise to a lot of people. And they're all illiquid assets. So if you owe estate taxes on real estate, your heirs are going to have to sell it in order to pay the tax on it. And 40% of that goes to the government. And I've seen that happen.
That's a lot.
Yeah, I mean, back in the day, I mean, the estate tax exemption has changed so much over, the years. I remember when it was $675,000, which seems crazy now. Like I mean, there's, one property here in Dallas can be, several $1 million fair market value. But we had a client one time, I believe it was her aunt who passed away. She had a ton of rental properties all over Dallas. And when she passed away, she did not have she had like a handwritten will. So there was not a lot of,
Mhm.
you know, planning that went into this. She had money everywhere. She had bank accounts for like at all different banks for every single property. Like putting the thing together, like to go through probate was a gigantic mess. And then I think
Yes.
believe that my memory serves, like they had to sell like over half of the properties in order to pay the estate tax bill.
Wow.
Really, yeah, it was really, really kind of sad and a massive, massive problem for the people who, were, the executors of the estate. I mean, just giant issues.
Well, a couple of lessons that I think that we need to I would feel sad if I didn't share these. One, no handwritten wills, y'all. No legal Zoom. None of that. Go to an attorney and specifically go to an estate planning attorney, someone who does this every day of the week, twice on Sunday. That is the main core focus of their practice. And getting your estate planning done is not like a slow cooker. You don't just like do it once and walk away and hope it tastes good at the end. Getting your estate planning done, it needs to be reviewed every 2 to 3 years when there's a major life event, death, divorce, disability. I know I just said that it needs to be reviewed every 2 to 3 years, but like decade. If it has been more than a decade, you need to get in to see an estate planning attorney. When you have a business or open up another line of business, see your estate planning attorney. If you're not talking to your estate planning attorney every single year, just like your insurance broker, it's time to find a new estate planning attorney because having wonderful estate planning is leaving the treasure map to your family and you want them to find gold at the end and not a huge mess. So make it easy for your family to find the gold, leave it there for them. Otherwise, like the client Susan just talked about, it was a giant mess 50% of it went to just paying the fees. That probably was not the intent. So,
Yeah.
anywho, that is my soapbox for estate planning.
Yeah, I agree. And the other thing, Catherine, is that you got to work with an estate planning attorney who actually understands what you've invested in, and has some familiarity with the complexity that you have going on. Otherwise, you're probably not going to get led in the right direction. So
Yes.
that's a really big piece of it. So, all right. So the bottom line is it is just, it's time to make changes. It's time to go through and work with the right people,
Mhm.
accountants, attorneys, financial advisors, so that you can comply, you can take advantage of all of the tax benefits that you can plan for the future. You have the right relationships for making sure that the investments you're making are still making good business sense, and that at the end of the day, whatever those investments are that you leave behind, that the financial benefit outweighs the financial mess. So, and now we'll open it up for a couple of questions. Bring up my chat box here. Oh, the Q&A. All right. So it looks like we have a question related to what is, let me read the question specifically here. So it says, um, what, why do most people choose an LLC to place property? Okay, so let's talk about that. That's a really great question. It really speaks to sort of the entity organization, which we mentioned before was really the key. So I'm not an attorney, so I'll start by saying that. But typically an LLC is chosen because, as an attorney would advise you, it's an easy entity to maintain in the state's eyes.
Mhm.
But really, it's not necessarily all the state stuff that makes it appealing. It's that for tax purposes, an LLC can be taxed in all four ways. And you might say, okay, well, what are the four ways that an entity could be taxed? So an LLC, if it's owned by one person, it's called a single member LLC, and it's disregarded for tax purposes, which means that if you own real estate in a single member LLC, it's going to be reported on your Schedule E on your Form 1040. So you receive the benefit of having the LLC protection, but you don't have to file another tax return. It just goes on your 1040. If you have an LLC that is a multi-member LLC, meaning one or more owners, then that default taxation is a partnership, and your partnership would file Form 1065. An LLC can also make a election, if it's qualified to do so, to be taxed as an S corporation. Typically, you're not going to find that to be the most desirable taxing entity for real estate, but it is better for property management companies or any type of service entity, although there are restrictions and certainly some areas where that might not be the area that or the type of entity you want to be in. But an LLC can make that election to be treated as an S corporation. And then an LLC can also request to be treated as a C corporation.
Mhm.
Again, not the entity of choice for real estate, but there are definitely reasons why you might want to play in that sandbox. So, all an LLC can be taxed as any of those, and really is sort of this chameleon in terms of uh, the tax law. So that's usually why an LLC is formed, because it affords that type of flexibility from a federal tax perspective. So, all right, I'm going to see. Let me go back to my chat box here and see if there are any other questions that have popped up. Okay, another question that came in is, do you recommend QuickBooks Online for tracking your revenues and expenses? Yeah, I like QuickBooks Online.
Mhm.
I think that the most important thing when it comes to accounting software is is it modern, and does it have the right, um, can you integrate the right tools to automate your accounting? That's really the key. The great thing about QuickBooks Online is that it has an open API, which means that there are literally hundreds, maybe if not thousands, of programs that can sync data in and out of QuickBooks Online, which can speed up the accounting. So payroll can sync in, bank transactions, you name it, their POS systems, CRM. Now they even have like their own like MailChimp that, takes the customer data and pushes it out if, depending on what you have going on. So the other thing is that when it comes to selection of an accounting software, whether it's QuickBooks or anything else, you just have to make sure it's something that is widely used. So when people start picking software that nobody has ever heard of, and there are a lot of accounting softwares out there, or I mean, especially in proprietary industries, specific industries with proprietary softwares. I think that's the stuff you just have to stay away from. So QuickBooks is just universal. I mean, there are accountants who literally will be like, I don't know that program. I'm not even going to try to learn it. I don't even want to work with you. That's the danger of choosing something that's just too weird. And you got to stay away from free too. If it's free for a reason. Just gotta be super careful there. So,
and going back to what you mentioned earlier, QuickBooks has that classes feature. And so if you've never opened up QuickBooks before, for every transaction that comes in, you can kind of put a tag on it. And that's what's called a classification. It could be a location, it could be a property number, it could be any variety of how you want to classify that expense. And it allows you to have the financial data, yes, on your financial information globally and by each of those different classes. So it gives you a lot more reporting power and can be almost as powerful as your practice management software in those reports. So it's robust, it integrates with a lot of things. Pretty impressed with QuickBooks. And there's companies that are multi-million-dollar companies using QuickBooks. It's not just for, the mom and pops. I think that when QuickBooks was born, that was kind of the intent, and it still has that stigma. Sophisticated companies are using QuickBooks Online.
Yeah. I was actually talking with a real estate investor yesterday, and he's using QuickBooks Desktop and, hosting it on like a, cloud server, and that's all fine and dandy. However, I do think that what we're going to see probably in the next 3 to 5 years is that desktop's going to die. I mean, either Intuit's going to sell it or they're going to stop supporting it. They're already making it very unattractive because, and we all know this is the case. When you buy QuickBooks Desktop, you can have as many, files to access as many businesses as you want to set up. QuickBooks already knows. Okay, Intuit is well aware. As soon as they say we're not doing QuickBooks Desktop anymore, that their subscription level is going to probably double at least, because then you're going to have to migrate every single one of those separate company files into its own individual subscription. So, however, it is the future. So it may be more cost, but having everything in the cloud, I mean, it's coming. So you're just going to have to be prepared for it.
And it's not going to be a choice. It's kind of like getting a laptop nowadays. Like there's no CD disc reader. Like there's none of that. That's what we're going to get into. It's not going to be a choice. So get with it.
Yeah. I mean, they don't sell horses and buggies either.
No.
You pretty much have to buy a car. So awesome. Well, I think that's about all we've got time for today. So really appreciate you guys joining us. Check us out at unboxedadvisors.com. Always connect with either me or Catherine on LinkedIn. We love staying in touch with you and keep the conversation going there. So thanks so much.
Thanks.
All right. Talk to you guys soon. Bye.
Bye.